Hi, it's Matt Hale from Rising Tide here, and at the time of recording this, the All Ordinaries are down around 15% from their peak, which is a pretty large drop, the largest that we've seen since COVID. And off the back of the Trump tariff turmoil, we thought it was a really good opportunity to reach out to not only our client base, but people in our world to find out if they have any specific questions that they felt like haven't been answered by the millions of experts that seem to be putting forward their two bob's worth. Now, I won't cover every question in detail, but please bear with me because we did get a fair few. I've tried to distill the topics as much as possible, but also what I will underpin this by, if you or anyone you know is really feeling stressed or not able to get any peace of mind off the back of this, please reach out to us directly. Head to our website, lock in the time to chat, or alternatively, if you are an engaged client, please reach out to your advisor either through Rooms or send them an SMS or an email and just let them know that you feel like it's time to chat. Financial well-being absolutely stems from having peace of mind. So we want to make sure that even though there's a huge amount of issues and political craziness going on out there, that you feel like you're at least in a safe place and that you understand how this might impact your world. Now, what I will premise this by is that if you have already gone through the advice process or you are an engaged client of Rising Tide, we do take all these potential outcomes into consideration when we are drafting up, creating your strategy and then implementing your advice. And to give you some context, this is what's called a bear market, which is when the shares market drops by more than 20% from its peak. Those bear markets in history can last anywhere from around 33 days during COVID, right out to nearly a decade in Japan, in what's called the lost decade. They range right through in time, but what has always happened has been a new peak has occurred at some point in the future. So I suppose that is the underlying premise, is that if you are able to stay invested for the long term, you will eventually get to a new peak, but there is an opportunity cost in doing that. There is the sleep at night test. There is that peace of mind that I spoke about. So what we want to make sure that at all times that you feel comfortable, but also that we are aware of what any trade-offs of any changes that you might make will and how they will impact your potential goals. Now, the key themes in terms of the questions that we received is what's the right mix of investments for a volatile time. Now, to that one, I would say that because we have taken it into consideration that these bear markets and the bull markets do happen, that we want to make sure that your correct asset allocation or mix of investments, it will already be the right mix. The things that dictate how much you should have in Australian shares, international shares and property are things like how far away your goals are. You know, if you're 30 years old and you're investing for retirement in 35 years, it's likely you will have a higher percentage of Australian and international shares and a lower exposure to what are called defensive assets like fixed interests or lending money from the government. Another thing that was brought up was extra contributions. Should we be making extra contributions to our investments or super during a time like this? Now, this is quite an emotive topic and there is no right or wrong. There's a couple of schools of thought. Firstly is that it's a great opportunity, and if you think about it in a property mindset, if that you were going to buy a property in the next 6 months and it dropped by 20%, there's a good chance that you would see it as an opportunity, particularly if you're going to be holding it for the long term. But if you were trying to guess and wonder whether that property is going to go back up in the next 3, 6 or 12 months, we would definitely recommend against it. So high level, if you've got contributions that you would generally be making month on month, there is an opportunity to have that conversation with your advisor to bring some of them forward, but equally it's got to feel right. As I said, a new peak will get reached at some point in the future. We just don't have a crystal ball, and anyone that tells you they have a crystal ball and they know what's going to happen, please walk away. One of the things that I really want to help people to understand is that these cycles are absolutely normal. your strategy is designed around it. But as I said before, if it is causing you significant stress, then it's time to check in. Many people in our client base, the only exposure they've had to these severe drops may be COVID, where markets dropped really quickly. And as I said, that bear market only lasted 33 days before it came back. But another one is the global financial crisis when I was advising, and that took a longer time to play out, and there was a lot of volatility. It didn't sort of happen like this, where these political changes have created a trade war, but nonetheless, it was a crazy time. And what we learned is that not making rearguard changes is what is really important. At a really high level, we are comfortable in the strategies that we've put in place for our advised and engaged clients. Where we do worry a little bit more is where people have not made conscious changes to their superannuation, to their investments. They haven't been engaged, they don't have an advisor, and it could be causing them a huge amount of stress. A really good example is that many people that open up a super fund can be put into a default investment option, which might have a really high exposure to Australian shares and international shares, which would be dropping a lot at the moment, maybe more or less than that 15%, but somewhere around that mark. But what I would say for Rising Tide clients is that for the majority of our clients, we have highly diversified portfolios. So please focus on your portfolio, not on the headlines that you see. As an example, one of our team today looked, and the investment option that many of our clients are in had dropped at 9% as opposed to 15%. So that can be a significant difference. So don't get too caught up in the headlines. If you are stressed, please pick up the phone, give us a ring, but bear in mind, this is all taken into consideration. Finally, for those people that are drawing down on their superannuation or investments, if you are drawing down from the cash portion of your portfolio, this will not be impacting you as much as if you are drawing down from the invested side of your portfolio. If you're not sure about that, please reach out to your advisor directly. And once again, if you've got any ambiguity, uncertainty around the whole situation, or you're just feeling really average about it, drop us an email. My email is matt@ctrt.com.au, or find me on LinkedIn.